Good afternoon, everyone. My name is Matt Beckley. I'm a partner here in DJH Corporate Finance, and I'm chairing today's meeting. My background is I've spent about 30 years in corporate finance and transaction services. And over that time, I've advised founders on both sell side and buy side and led many corporate finance, financial due diligence transactions for PE houses over that period. Private equity, to some people, it's a scare word. To others, it's a huge opportunity. But generally, it is misunderstood. So today, we're going to explore further and with the aim of demystifying private equity, how it works, what it actually is, and crucially, what it actually feels like to be within an environment which is PE backed. So in order to do that, rather than just do it myself, I thought it's important to give you at least more than one perspective. And in this regard, I've got my colleague, John Else, who's a corporate finance partner in the team. He's spent a number of years in the middle of these transactions that we're going to talk about today, advising owners when the right time to exit, who they're going to approach, and project managing the whole process. Secondly, we've got someone who's closer to the money. That's Dan Walker's a senior investment manager at Foresight. Foresight is a private equity house that's backed many local businesses over a number of years. And he's going to give you an overview of the PE market and tell you what he's generally looking for and how you can stand out from the crowd. Finally, and probably the voice a lot of you will find the most value from, is Scott Heath. Scott's the CEO of DJH. He's built DJH up and sold a stake to a private equity company 3 years ago. So he's lived the PE experience and is still living it. So hopefully he'll be able to illuminate you with the good bits, the bad bits, some of the challenges, and some of the enjoyable bits in between. So a deal maker, private equity house, and a founder. And just a little bit in between. At DGH, we obviously do sit in the middle of these transactions a lot. We work very closely with our many offices around the country, tax side, audit side. So we have a full service offering. Once the three of them have spoken, there will be an opportunity for a Q&A at the end. So just jot down your questions in the question box. And without further ado, the first person is John. Over to you, John.
Thanks, Matt. Good afternoon, everybody. My name is John Else. I am a corporate finance partner here at DJH. We're based in Manchester, but we operate nationally. Bit of brief background about me. I am a chartered accountant. I train with PwC here in Manchester and qualified in international tax, actually. And then upon qualification, I left and joined a specialist corporate finance boutique over in Liverpool. Spent 10 years there working with owner managers on acquisitions, business sales, MBOs, the full range of corporate finance transactions. In 2011, I joined a former client of mine, which was a consumer law business that I'd advised on an MBO, and I spent just over 10 years working as part of the management team of that business. We looked at private equity as a management team, but the transaction didn't go ahead for a variety of reasons. And then in January 2023, I came back into the world of advisory and I joined DJH. So what are we going to talk about today? We're going to look at why someone would want to look at private equity. Now, as I said, we deal with clients who are looking for investment to grow their business, looking to realize value from the business through a sale, or a combination of the two. And that's often where private equity can come into play. So why would somebody look for private equity investment? So point one here, growth capital. So looking to grow a business, and PE is there as a source of growth funding. Now, whether that can be organic growth, entry into new territories, new markets, that kind of thing, or looking at an acquisition strategy which will be funded by private equity. Now, as part of a PE transaction, it's possible to de-risk, to realize some value today, and then stay invested in the business with a material interest in that business, and then work with the PE investor towards a full exit in a 3 to 5 year time frame. The event where the private equity institution comes on board also gives the opportunity to for the management team to become shareholders in the business, which provides a real incentive for them, and they'll be aligned with your goals, with the investors' goals, to deliver that growth plan and the successful exit. And also, the equity incentive can be used to attract new talent into the business to strengthen the management team. And also, and I'm sure Dan will talk about this, a good PE investor brings more than just money. So there's knowledge, there's experience, and often a network of operating partners alongside an experienced non-exec director or a chairman. So often when people come to us and they say they want to sell their business, their main thought is around selling to a trade buyer. And as part of the discussion we have, we will always talk them through the potential differences between private equity and trade, and also why private equity may be a better alternative for them. So as we were saying before, with a private equity investor, you retain an investment in the business and you are there to run that business alongside your investor, but they're backing you to deliver your plan. You will use that funding to accelerate the growth with the additional capital, with the strengthened team, and look to realise that exit within the 3 to 5 year time frame. With the trade buyer, you sell 100% of the business and in all likelihood realise more value today, but your upside in any future situation is limited. Typically, there'll be an earn-out payment linked to the future performance of the business, but there'll be a cap on that. Whereas in the private equity scenario, you're working towards the secondary exit, and as a shareholder in the business, your potential realization of value is uncapped. Also, in the trade situation, you will be fully integrated into the buyer's business, whether that's on day one or over a period of time, and that may well lead to a change of culture. Whereas under a private equity ownership, potentially you can retain and grow the business that you've got and keep all of those good bits. So that is moving us on to the role of the advisor. What would we do at DJH when someone comes to us looking for private equity investment? First of all, and this is most important, we really need to understand the aims and objectives of the founder, the shareholder group, and understand the business and see whether private equity is the right option for that business. Not all businesses will be attractive or indeed relevant for private equity. And as we said before, a private equity investor is looking for growth. They're looking to ideally 3 times their investment back within the 3 to 5 year timeline. So has your business got the potential to deliver that growth today, or can the private equity investment come in and be the catalyst that creates that growth story? We sit down with our clients and we will explain the pros and cons of all options, private equity, the trade route. There is a loss of absolute control in all of those situations. And in the PE environment, whilst you retain an investment and you will be backed to run the business, you will be accountable to somebody else around the boardroom table. And then once we've understood the business, once we've understood whether PE is a potential option, we then look to connect our clients to the right type of investor. And that will depend upon the size, because certain investors will have minimum and maximum deal sizes. Some investors will prefer certain sectors over others. So we use our knowledge and experience of the market to put the right people in front of our clients to move the business forward. And point number 5 there, it's our job to lead that process from the very first meeting all the way through to the completion of the investment and beyond. And at that point, I will hand you over to Dan from Foresight.
Great, thanks, John. So yeah, good afternoon, everyone. Thanks for taking the time to join today. Hopefully, I can give you a bit of a perspective from someone in private equity, someone who's making the investments, give you an idea of kind of what we're looking for and how we operate. So brief bit of background on me. I'm born and bred in Lancashire. Originally started my career at KPMG, chartered accountant, trained in Preston and then in Manchester. And I've spent probably the last 15 years of my career in and around the Northwest. So following that, I joined a corporate finance business called Dow Schofield Watts, advising on similar sorts of M&A transactions to John and Matt, in value sort of 5 to 100 million typically. Was a director in that team, was there for 8 years. And then I joined Foresight last year to try my hand at the other side of the table. So making investments rather than trying to find investment. So I'll give you a brief bit of background on Foresight. So we're quite a big organisation as a group. We're listed on the London Stock Exchange. And as you can see there, a few stats. We've got a few hundred people employed. Offices primarily in the UK, but a few across Europe and Australia. We've got kind of two sides to the business. So of the 13 billion assets under management quoted there, vast majority of that, around 10 billion, is in our real assets or infrastructure side. So that's investing in renewable energy infrastructure like wind farms, solar farms, battery storage. So that's a big chunk. Slightly separate to the private equity side, which I sit in, which is, I would say that, but probably the more interesting part of the business. So that's where we're investing in growing companies across the UK, primarily in the regions. So I'll just flick over and tell you a bit about the private equity side of the business specifically. So yeah, as I say, I sit in that part. So I sit in the Manchester office. We're regionally focused, as I say. So we've got around 15 offices across the UK now, investing into regionally focused growing businesses. We originally started that team in around 1980, so we've been going a long time, primarily focused at the start in early stage tech investments. But gradually over the years, we've massively diversified. So we look at all types of businesses in all types of sectors, variety of sizes, which I'll come on to. But we're currently invested in around 250 companies across the UK. And we've got around 3 billion invested into those companies, as I say. We've got around 800 million kind of fresh capital to deploy at this moment in time. So really keen to find businesses to invest in. There's a little bit on there about kind of what we provide. So obviously the capital, the money is a very important part that John points to. But the key for us is identifying growing businesses that would benefit from not just the capital either into the business or for the shareholders to kind of de-risk their positions, but from our experience in having built businesses and help support with businesses like this over the years. So we've got a wide network. There's probably 70 people doing a similar job to me across the UK, doing transactions and sitting on boards. We've got a vast network of non-execs and direct chairs and other types of specialists who can help advise the businesses as they're on the growth journey. And we've seen a lot of situations as well. So whether that's expanding overseas, launching a new product, growing a sales team, and pivoting the business into new markets. And just a nod there to the bottom. So the primary focus for us ultimately is to make returns for our investors. We've got a really good track record of that. But ultimately, we're investing alongside shareholders and management teams. And so where that track record applies to our investors, it also applies to them. So we kind of very much adopt a partnership approach. Flick over. So the types of investments that we make. So you could probably segregate these 3 buckets into 2 really. So ventures and growth on the left-hand side are growth capital investments into businesses. So that's cash in for the types of situations I was talking about before. So whether that's launching a new product, expanding overseas, ramping up your sales efforts, or hiring more members to kind of build out a management team where the business might be potentially reliant on a founder. On the left-hand side, the ventures businesses are typically more IP heavy businesses, not mature, need help with commercialization, and typically in kind of deep tech or software or biotech industries like that. The growth in the middle, those businesses are a bit more established, so definitely revenue generating, typically generating 2 million revenue or maybe 1 million if it's really solid recurring revenue. And they're businesses that are approaching profitability. So we're investing to help sort of accelerate that transition. And then the right-hand side, perhaps more relevant here, is our buyout funds. So they're for all sorts of different transactions for businesses that are a bit more mature. So almost certainly profitable, growing businesses based in the regions where the vendors, founders, shareholders are looking to cash out a substantial portion of their equity proceeds in some cases, but some cases not. So sometimes that will be growth capital only as well. That can be funding for acquisitions, all of the other situations I mentioned previously, or just where the vendor wants to transition their ownership over time and step away from the business. But ultimately, we've always got an eye on the exit that may come in 3, 4, 5 years' time, which hopefully for us and the shareholders is kind of a bigger capital event than the first one typically. So that's kind of what we do. Just flick over briefly. So I mentioned we invest in all sorts of industries. There's not really anything we won't invest in. So a couple on here. So the way we work is that we'll typically, the same person will identify the transaction, work through all of the work streams with the corporate finance advisor, like due diligence and legals, etc. And then ultimately sit on the board. And a couple I sit on the board of there are Federal, which is a Northwest-based cafe chain. So it's got a few sites in Manchester and some others across the Northwest. And Argyle, which is a road surfacing business working with local councils and house builders. So couldn't be more different, really. But yeah, massive variety in businesses there. We've got wealth management, drone businesses, property consultancies, law firms, so all sorts of different things. So we don't really preclude ourselves from anything, provided it ticks the boxes from a growth and plan perspective. And then just a variety of our exits at the bottom there as well. So that's kind of a summary of us. I think now I'll hand over back to John.
Thanks, Dan. That was really interesting. Really good. Thank you. So, couple of further points from me. I'm going to talk a bit about getting prepared for private equity investment, but this is getting prepared for PE could be a webinar in itself. So I'll just touch on a few points here. So how can we help you sort of get ready? First of all, is sort of making sure that the strategy hangs together. So have you got a plan? And how will the private equity funding help you achieve that plan? If I'm an investor looking at your business, what are the key opportunities, but also what are the risks, and how can we capitalize on those opportunities, and how can we mitigate those risks? And then the PE investor is ultimately backing the management team to deliver. So looking at the team that you've got, have you got the people sat around the table to deliver the plan? If not, and there are gaps, then they can be covered off as part of the process. So really, it's making sure that when you have those initial conversations with people, you've got a clear vision for what you want to achieve, and how the PE investor will help you take you there. So then, in terms of sort of the more of the nuts and bolts of the implementation, how can we assist? Well, we can look at the management information that you prepare. Does it provide the level of detail that an investor will want to see? Does it give a true picture of the business performance and the sort of look forward position? Does it capture the key KPIs that you use to manage the business? We can challenge the assumptions around growth, and we can help you build out a set of forecasts, because ultimately those numbers are going to be subject to financial due diligence. So it's got to hang together, it's got to be robust, and it's got to be able to come up to scrutiny. And then when we embark upon a process, we will work with you to prepare a very detailed information memorandum, which will be the business plan that really articulates the equity story, the reason why the PE investor should invest in your business. And then in terms of very briefly, what we do as part of the process, there are a number of key stages, and DJH, myself, Matt, and our team, we stand side by side with you throughout that process, and we will be there, and we will take you through the initial meeting, as we said before, right through to the completion, and then beyond into the new world of private equity relationship. So we'll work with you to prepare the information memorandum. We will make introductions to both private equity people that we believe would have an appetite to invest in your business of your size and in your sector. We'd also typically run a process alongside trade, so that you as the client have got the ability to compare and contrast what a trade sale route could look like up against the private equity route. We will arrange management meetings, and we will sit in with you in those meetings. We'll help you prepare a management presentation to present your business to the shortlisted trade buyers, the shortlisted private equity investors. And that's very much a two-way process, because the chemistry's got to be right. If you're selling to trade, you've got to be happy that it's the right home for your business. If you're looking at private equity, the guys that you are talking to will be with you on a journey for a 3 to 5 year timeline. So you need to make sure that the chemistry is right and you can work with these people going forward. Next stage in our process would then be to invite the offers for the business, and then we would sit down with you and we would go through those offers, and we would negotiate those offers and get to the point where we have a preferred bidder, we agree a team sheet, and then we crack on into the nuts and bolts of a due diligence process. And that will cover all aspects of the business: financial, legal, commercial, HR, environmental, property, sort of tailored to the precise nature of the business that we're dealing with. We work very closely with the lawyers to make sure that the legal documents accurately reflect the deal that's been done and help in the management of risk. And we are there as the leader of your deal team to provide as much support as you need throughout the process. And yeah, if anyone is considering it, of course, we'd be happy to have a separate session with you to talk about that in a lot more detail. So now we're going to hand over to our CEO, Scott Heath, to talk about what it's really like working with a private equity investor.
Thank you, John. I think probably do a bit of an introduction first of all. I've been at DJH now. I'm the current managing partner or CEO. It's changed a lot in my time. When I first joined the business, it was turning over $1 million. Today we'll do 72 million. So there's been a lot of change on that journey. Prior to our journey with private equity, we grew the business organically. So from 2019 through till 2022, we went on quite a growth journey and grew the business from 4 million revenue to 16 million revenue. And that was interesting and came with its challenges. And that's when we were faced with, okay, what do we do next? What's next for DJH? Now, my advice to anybody, having your own business is really tough. So it's like your baby, it's your family member, it's your life, and it's really important to you. My advice would be just to have a plan. It's dangerous not to have a plan. So you should explore all options. You should explore maybe, and there could be whole different webinars on different things. You could explore management buyouts, you can explore tax structuring, and you can explore trade sale or private equity. But you shouldn't discount any until you've done your own research. So for me, the key is to have a plan, explore, and go and learn more about it. Private equity isn't for everybody. In my journey, I spent 12 months talking to different private equity houses, talking to different sort of people who've been through the journey and learning as much as I could to kind of better my knowledge. So kind of starting early in your process or starting early in your conversations with professional advisors would be one of my recommendations. Private equity are definitely good for strong, growing, and ambitious businesses. They will support you and they'll push you to another level. The key is to find the right partner. I know on my journey, I spoke to over a dozen partners, and there was some that I came away thinking I could never work with you. And then others I thought, okay, I like what you're going to bring to the table. So taking plenty of time to meet and kind of greet and explore, you'll learn lots along the way. You'll learn lots about your business. You'll learn lots about the good things in your business that make people interested in it. And you'll also learn about the challenges. So in our journey, I was spending time with different private equity houses. And each time I'd come back with more and more knowledge that I can implement in the business, which was definitely worthwhile. It is different, the other side of the fence. So when you have an investor on board, like Dan, for example, you do have, and my partner's Tenzin, you do have to have a lot more governance. So you're no longer that person driving the car on your own or running the business on your own. You do have a lot more reporting to do. I know Dan's talked about maybe chairs on the board, and John's talk about strengthening your management team. It is different. But it is right for some businesses, so it's not to be explored. It's a fast-paced, so private equity, John mentioned that it's a short period of time normally that they invest for. They normally invest for 4 years. That's not every fund though. Some funds will hold the shares longer. I know Tenzin, for example, are holding us for another 4 years, so it'll be 8 years cycle with them. And it's an interesting process, so it's really important you spend time with the investors, because whilst you're getting to know them during the process, you're on the sell side. But then once the deal happens, all of a sudden you're kind of in the team working with them. So it's just finding that balance between kind of running a process with them, but also being the other side of the fence post transaction. My biggest recommendation would be, at some point, you've got to do something with your business. Your business can't be held forever. So at some point, you've kind of got to do some kind of transaction. And private equity does give you the ability to de-risk. One of the pros is you might have a growing business where you want to hold on to it. You still want to carry on running it, and it's growing nicely, but you want to de-risk so you can do some things in your personal life and enjoy the fruits along the way. So private equity does give you the ability to de-risk and reinvest again moving forward. But it also gives you some kind of timelines as well. So coming back to Dan's point, where how long people will invest for, is it? You kind of say, okay, I've done one transaction where I take some funds off the table, but you kind of do know there should be a second transaction and maybe a third transaction. So it gives you kind of nice roundabout events where you can kind of have a target to aim for in the future. Enables you to make bigger investment decisions. I think the challenge when you're running your own business and kind of you have to reinvest in people and infrastructure and capital equipment and the growth of the business, when it's all coming out of the shareholder funds, that can kind of be tiring, and kind of taking those educated gambles when it's all your own money can be quite difficult. But when you've got institutional money alongside you, it makes you become a bit braver, and like you can probably accelerate some of your decisions so you can kind of overtake your competition or maximize your growth. So it definitely makes you braver. And then the big thing for me, it gave me an opportunity to do, was to incentivize my management team. So as we were growing the business, rather than just having the cake and the slice of the cake just for the kind of the owner or the entrepreneur, what private equity did with some share structuring and some share schemes enabled more people to benefit in that growth, which means you can retain better talent. You're sharing the rewards of the business with your team, and everybody's winning along the way. So I found that a really useful part of my journey. And then I'd probably just wrap it up with use professionals. It's hard enough running your own business. So I know when we were running our transaction, it was like 24/7 late nights, and you're trying to run the business and you're trying to get an investor on board as well. Using professionals and finance people and kind of the right professionals enables you to kind of have support and help along that journey, because it can be quite stressful. And I'll just say, don't rule it out. You've got nothing to lose to have some chats at some point you do have to do something with your business. And there's all different sizes of private equity funds. I know it isn't just for big businesses. There's smaller funds and there's larger funds, and kind of so exploring it and kind of getting to know more about it will only kind of give you more knowledge on your business. It's been to date, Tenzing have been invested since 2022. When they invested, we were turning over 16 million. This year we'll do probably 90, I think. So there's been substantial change. But what it has enabled me to do is invest in cybersecurity, AI, better technology, more in my learning and development, more in my people, more in my systems, and also the products I can offer the clients. So it's kind of enabled us to run a lot faster than we would have done if we would have just stayed privately owned. So yeah, it's fast paced, it's enjoyable, it's stressful at times. So my advice would be take your time, meet plenty of partners, and then choose the one that's right for you. I think I'm back over to Matt to do a roundup and take some Q&A.
Hi everyone. Thanks guys for that. So you've heard from the three perspectives. I mean, when we decided on doing this webinar, it was quite interesting because we just discovered the recent research which says there was 190 billion pounds worth of dry powder within private equity. And we looked at our own balance sheet and we were working on 400 million pounds worth of transactions, of which 90% of them involved either direct private equity negotiations or with private equity backed businesses on a buy and build. So it is hugely relevant. I'm looking at the questions now to try and get everyone involved, and there's two questions at the moment I'm waiting for, and both probably can be joined. There's because although you touched on it, perhaps dig it under the bonnet a little bit. There's Emma from Stretford. She says, what the key things an investor brings to the table aside from money. And then there's another question from Matthew from Cheadle, which says, would an investor be involved in the day-to-day decisions or just the larger strategic decisions that have to be made? Because again, Scott, you talked about governance, greater reporting requirements and strengthening the management team. So just wondered if both Scott and Dan could maybe...
Yeah.
You want to kick off, Dan, and do the investor side first, and I'll give you my version.
Yeah, I'll try and convince you it's more than just money. Which money's obviously a really important thing, and Scott touched on it. You might be working in a growing business, owning a growing business, and you want to take some cash off the table and then carry on benefiting from the growth. But aside from that, probably the key one really is the network. So we've got 250 businesses in the portfolio and probably exited about 100. And we built up a really good network across all industries, I guess. A good example is, so the business Federal that I mentioned is a coffee chain based in Manchester, had 3 sites and it's got 1 in Leeds now. We got a chair to join that business, a lady called Karen Jones, who previously founded Cafe Rouge, floated that when it had about 100 restaurants. She's on the board of Deliveroo, Hawksmoor, she's the chair of that. So I'm sure the founder of Federal wouldn't mind me saying that they wouldn't have been able to attract the person of that caliber themselves. But Karen, having worked with us on another business called Mowgli Street Food that you might have come across, I kind of like the way we operate, and so she was keen to get involved in Federal as well. So bringing that sort of caliber of person to advise the business who's been there and done it before is probably a key one. That's external people, then us as well as a team. Seen most situations before, I suppose, and we can bring a lot of experience to bear in that, whether the business is debating putting prices up or what the optimal pricing structure should be for their products or services, or maybe they're pitching for government contracts and want to help, some help in understanding how best to position themselves, that sort of thing. But ultimately, we've got an eye on the exit, and we know how to, I guess, help shape businesses over a period, with an eye on them being more valuable at the next transaction event, and that's what it's all focused on really, and that's what we're experienced in doing. So I don't know if you had anything to add, Scott.
Yeah, I think the reality of it is when you do take a private equity investor on board, you are selling part of your business. So all of a sudden, the day afterwards, you've got an investor in your business that's got an ambition to get 3 times return down, as you mentioned, and most private equity houses work on a minimum of 2.6 times return. So they are focused on driving the business forward probably faster than you would have done before, and with more investments going at the same time. And I think this is key, where you've got to spend lots of time getting to know your private equity partner beforehand. You've got to have a plan, and you've got to be confident, or you've got to be happy you can deliver that plan. But it is different, the other side. Now, day-to-day decisions, they're not going to get involved in who you hire and who you fire and kind of operational stuff, as long as the business is on track and going to plan. Where they will challenge you is your governance changes. So all of a sudden you're having a monthly board meeting, where I didn't used to have a monthly board meeting when I ran my own business. I just kind of went with it day to day. And you do more reporting, you do more data analysis, and you kind of challenge your business plan also. So they bring a lot more governance and structure and a lot more challenge. And I describe it as kind of, if there's 5 gears in your business or 5 levers, they'll want all 5 levers on forward all the time. And that isn't for everybody, and it isn't for every management team. And you might lose some of your people, and that might be the right thing. So some of your people might move on because it's not for them. But then you do attract better caliber people. And as Dan had mentioned, you can kind of bring in the skill set to take you to the next level. So I think if you're on track, private equity leave you alone. The experience is, I think if you start to miss your numbers, then they'll start to question the business a bit more. But why shouldn't they, if they're heavily invested in it? And therefore, you then work on solving those problems together. What they will be is they're side by side of you investing, so they want it to be a success like you want it to be a success. So.
Great. Thank you. Thank you, both of you. Another question. This is Roger. I don't know where you're from, Roger. Could be Rochdale. But the question for Dan: what proportion of Foresight's investments are EIS? And of these, how many are in knowledge-intensive companies? I haven't got a specific question as to what his business might be, because knowledge investment-intensive companies can be far and wide. I'd say our accountancy businesses is potentially knowledge-intensive, but then you can probably go as far and wide as IP-generated businesses. But over to you, Dan.
Yeah. So yeah, thanks, Roger, for the question. I won't put a number on specifically how many. So I think I talked around the 3 sort of buckets of investment that we've got at the start. There's the ventures, growth, and buyout. We do EIS, and we also do the kind of bigger brother to EIS, which is VCT investing. Both got kind of the same criteria attached to them in terms of what's investable and what's not. And we do both. Yeah, if it's a specific question on a specific business, I guess we've got really good ties with our advisors and lawyers and tax advisors on where it's necessary, justifying that knowledge intensive criteria being ticked, if that supports us getting investment into the right businesses. And like Matt says, it's not just kind of early stage cutting edge technology that can be qualifying as knowledge intensive. There's all sorts of things across our portfolio where we kind of lean on that criteria being ticked. So if there's a specific question, happy to answer it afterwards, or if you want to link up, I'm sure you'll get the contact details. We can talk about that.
Okay, we've got another question from Graham. This is probably a double-edged one, but there's a number of questions it raises about when's the right time to invest, how big does a business need to be, where is it on its journey. But he's a CEO, Graham, of a small but growing consultancy in the defence sector, specialising in accelerating capabilities in high-tech secret operations. Oh, Graham, that sounds interesting. We're just 18 months in and 20 employees, but expect to double year on year, and will want funding to take the business to the next level. How do I know when the right time for this is, and how will this affect our overall control? I think this is a really, really interesting question, and there's a balance. So John, maybe one for you, and maybe as Scott's told you about his journey, he was relatively small. So yeah,
Yeah, John, do you want to kick us off, and then I'll kind of
Yeah,
do my
yeah,
role?
I'll kick us off. I mean, interesting question, a very interesting sector that Graham's business is in. We actually sold a business late last year that was in the defense sector, a consultancy business. That was sounds not dissimilar in terms of employees. 20 engineers working on some very secret operations. Ultimate client being a part of the government. So how do you know that when the time is right? I suppose let's look at, it will depend upon when you think the funding is needed. What do you think that funding will be used for? Um, is it something that could be funded from the trading cash flow as the business grows, or is there a need for a significant injection of capital to accelerate the growth? So that would be, I think, a situation where we'd love to sit down and have a conversation with you, Graham, to discuss, how we could potentially help. I mean, the business that we sold back in November. That went to a private equity backed trade buyer, but we did have some significant interest in that business. And subsequent to us completing that transaction, we have been approached by a number of people operating in similar sectors. So in terms of when is the right time, I think that will a big driver to that is when do you think or when do you anticipate you need the funding, and what will that funding be used for?
I think, John, yeah, it's a really good summary. I think in my journey, as we were growing the business, I started to talk to private equity when we were making about 2 million profit. And we didn't actually then do a deal until we were over 4 million profit, because you were learning along the way and you were going to talk to people. And each time you learn more and more. And it comes down to personal circumstances as well. We didn't have a lot of debt when we took a private equity partner on. We didn't have any debt in the business. There's times I have days where I think, okay, I didn't need to take my private equity partner on as early. I could have put more debt into the business and grown it off debt, and then done a deal later on. But it all comes down to de-risking at some point, and how does that suit your own personal needs? So in your position, I'd be saying it's never too early to go and learn. The more you speak to private equity, if they are interested, they won't give in. They'll keep coming back. And the fact that you keep saying to them, like, it's too early for me, it's too early for me, all you do is the competition, the price nudges up a bit, because if they want it, they will wait patiently. They will take minority stakes with you rather than majority stakes. You can put debt in first. So there'll be a point in your business that you can achieve more by taking on the partner than you would just carrying on your own. And that's the bit then I think you should consider private equity. And that's where we got to, is like, we could have carried on a bit longer, but the risk profile would have been out of where I wanted to be. And then we could ultimately achieve more by taking a partner on. But if you can keep doing it as far as you can, don't leave anything on the table, because that's maximum value for yourself and your other shareholders.
Yeah. I'd just add as well, Scott, thanks, Graham, for the question. From our perspective, well, first of all, to get to that many people after only 18 months is really impressive. So well done on doing that. But there's a lot of focus on defence at the moment, a lot of funding for it, a lot of focus on sovereign defence capability. And we're very interested in it as well. So we're raising a defence-focused fund at the moment, focused on kind of resilience primarily. And we've got a track record of investments in drone technology and software with defence applications and civil. So it's the sort of thing we look at, but spot on with Scott. It's about finding the right time.
And the right partner, Dan, isn't it? Because
Yep.
if you're going to find a partner in that space, you definitely want to find someone who's been there, done it, got the
Yep.
right chairman who's going to open more doors for you faster than you can ever imagine, maybe done something in that tech space so they can really leverage like supply chains and things like that. Don't just pick somebody to give you the funding. You want someone who's going to bring skill set to the business.
Yeah, absolutely. And like similar to Karen before, the business we had called Kellen Lens did kind of drone software, ultimately sold that to a subsidiary of BAE Systems, and had a really experienced chair along for the 3 or 4 years that we invested in. We invested in multiple tranches along the way. So facilitated an initial deal that was maybe smaller than they needed to help them dilute less and kind of take as much investment as they needed at the right time. So kind of dovetails a bit with what Scott was saying about don't take more funding than you need ultimately.
Thanks for the question, Graham. Defence is obviously an interesting topic at the moment. Some of us feel exposed from certain nations. Keir Starmer's been pressured into spending money, whether he will or not. Well, only time will tell. But it brings us on to the question from Ben from Bramall, which says, what sectors are PE most interested in at the moment? I think we've touched on some, but what sectors are they kind of avoiding, especially AI and software businesses? You know, can anybody give us a feel? Maybe that is one for Dan, but John as well, how values have changed over the last 12 months or going forward?
Yeah, I'm happy to give a view from our perspective. Or John, do you want to kick off?
Yeah, I mean, I think, you know, there is no sort of definitive list of sectors that private equity will or won't invest in, I suppose. You know, we can talk about whether consumer-facing businesses, retail businesses, businesses subject to discretionary spend, you know, probably aren't flavor of the month for everybody. But, you know, Dan and Foresight have just done the investment into Federal. You know, so, you know, it depends on the opportunity and the fund, the management team, the business. In terms of what we're seeing at the minute in terms of active sectors, you know, Foresight again. You guys have just done investment into a business called Graham and Sibbald, building surveyors business up in Scotland. Now we've done 2 transactions in that sector over the past 18 months involving architects, building surveyors, and, you know, general sort of building services. So we're seeing a lot and a growing number of private equity investors working in that area. LDC have recently done a transaction in a similar business as well. In the legal market, we're seeing sort of early, I say early, it's kind of gathering pace now that what happened in accountancy, whilst not strictly can't be replicated the same within the legal services market, but we're certainly seeing more and more PE interest in legal services. And also, you know, we're looking at a number of things in sort of more traditional industries. You know, we've got a heavy engineering business that we're working with. We've got some industrial doors clients, and we've got some HVAC businesses that are all looking at private equity sales and/or investment. So going back to your point, Matt, about AI, you know, AI isn't replacing, you know, an aircon system or an industrial door anytime soon. So yeah, that would be sort of some thoughts on what we're seeing at this point in time. Dan, over to you.
Go on, Dan. I'd just perhaps maybe talk about how much capital is actually out there as well, because there's an immense amount, isn't there?
Yeah, absolutely. Yeah. But yeah, I echo everything John said there, really. We're totally sector agnostic, but yeah, mentioned defence, that's a hot topic at the moment. A lot of money being spent there, and a lot of money available to deploy there, as Scott's saying. So we've not really talked about it, but private equity have kind of been holding on to assets a little bit longer, and as a result, there's kind of more and more capital to deploy as people's pension pots and other investment vehicles kind of get diverted to private markets when the public markets aren't necessarily doing as well in the UK. So a lot of money to spend. We've got 800 million. Everybody else has got a lot as well. We'll invest in kind of retail businesses or B2C businesses, hospitality, as John said. So some areas where some private equity might shy away from, we don't, and that's primarily down to us having a much bigger portfolio than most. So we can afford to have a few investments in all sorts of industries and then not still be overweight in any particular sector or situation. And the AI risk and move towards kind of traditional businesses, I think, is something we'll probably see as well. So people doing real things, digging holes and fixing things like that. Traditional service type industries will continue to be interesting to people, I think.
Okay. Just a matter of interest. So people's intuition is that, you know, do they want to buy and build, or do they want to sell now? What's the new normal? Because there seems to be worldwide crises all the time. Intuitively, you'd think a trade buyer would pay more for a business than a private equity house. Is that true, or is it not true?
I mean, when we have run processes where we've got trade buyers alongside PE, there hasn't been a great deal in it, I must say. I don't know what your experience is, Dan, when you're pitching potentially against the trade buyer.
Yep, I think there's certainly situations where trade can pay more. It might be more relevant for much bigger businesses than the types that we invest in typically. So where trade parties can pay more, that's where there's a lot of synergy between the businesses. Whereas the sizes of businesses we invest in, maybe up to sort of 100 million value, there's not a load of cost that can be cut out there, and we wouldn't want to do that anyway. So
And Dan, that comes back to what you want for your business, doesn't it? Because if you, for example, do you want to be swallowed up by a trade buyer and all your management team gotten rid of, and you walk out the door the next day, potentially as one option, or do you want to keep your brand and keep it building and grow it with a partner in private equity that's going to help you grow it? So it's like each option is different, and you can look at both because it creates competitive advantage as well, doesn't it? Because it's quite hard going out and finding a trade buyer sometimes because of confidentiality as well, isn't it? And kind of, do you want to go to your competition and let them know you're looking at your options?
Yeah, and it's got to be the very specific right time for the trade buyer as well. I've been in the same position as John and Matt, and it's not always easy to find the right strategic buyer at the exact right time, but private equity will give you the option to take some cash off the table now, carry on running the business the way you want to, and help transition the ownership to your team and help them sort of reap the rewards as well over a period until such point as the right time comes to maybe sell it to trade at a later date.
Quite
Yeah,
hard when
the
you're running.
stars. Sorry,
Go on,
Scott.
John. By the way, John.
Yeah, go on.
You
Go
go,
on.
mate. You go. When
I was
you
going to
fire
say
away.
it is a case of like the stars aligning sometimes with the trade. I mean, we've done some fabulous deals where we found strategic trade buyers, and in other situations where we've got businesses that we've identified the people that we were sure were going to put an offer forward, and it's not been the right time for that business. That they've got their own stuff going on, and you are kind of things have to come together.
Yeah,
So yeah.
couldn't agree more. The one thing I was going to say is when you're running your own business, it does sometimes feel like you're going to the casino every night and putting your chips on red or black every day. And at some point along your journey, what private equity does enable you to do is convert some of them chips into other assets and kind of carry on building your business, but just de-risking a bit because running a business is tough.
Yeah, they'll give you the confidence to kind of reinvest as well. It's not that every pound you reinvest in the business is kind of coming out of your pocket. It's a shared investment and a shared growth mentality, really.
Okay, just there's only 5 minutes left, but a quick question from Dom. I don't know if he's being cheeky or just testing you, Dan, but about the news that goes on at some of these PE houses. But how should investors who aggressively invested in tech businesses and essentially paid high premiums, how should they react to the rise of AI, which is disrupting the value of their existing portfolio companies and their valuation? Should they look to cut the losses now, or should they look to use continuation vehicles?
Yes, it's an interesting question and a very difficult one to answer. But I suppose for the PE, and we've probably got some of them as well, who are invested in these businesses, it's about assessing what impact AI is going to have over the longer term. There's no point flipping the business into a continuation vehicle if the outlook's not good for that business, and you probably wouldn't be able to get that signed off by your investors in any case. If it's a case that short-term volatility in the markets and perception around AI is maybe negative, but that this business has got strong prospects, then definitely holding on to them makes sense. Yeah, we're taking a keen look at everything on new investments at the moment to understand what we think the impact of AI is going to be over time. It might be potentially overblown because there's a lot of good software businesses out there that perhaps people could code them off the side of their own desk, but are they realistically going to do that when they've got a professional product that somebody's built over many years? But yeah, it's definitely something we're looking at keenly.
Okay, brilliant. Thanks, Dan. Look, one final question. You know, there's no doubt a number of owners here, founders, listening to the wise words. We've got 3 minutes left. If they're thinking about a process in 12 months or 24 months' time, what's the absolute first thing you'd recommend they should be thinking about now to prepare them for that process? Scott, you've been through it.
You're on mute, Scott.
Yeah, my advice would be take some time out of your business. When you're running your own business, it's 100 miles an hour. Take some time out and go and speak to a professional person you trust, whether it's your accountant or a corporate finance team here, and just go and ask them about it and go on a journey learning more. You've got nothing to lose by starting the journey, would be my advice.
Okay. Anything from you, John, quickly?
Yeah, and perhaps I would say this, you know, to come have a chat with us at DJH, and let's see how we can, you know, assist and advise and start to shape something that, you know, might be a 12, 18, 24-month process. But it's never too early to start talking to people.
Yeah, I'd echo that as well. Just have some conversations with people who've been there and done it before, or advised on it, or investors, and to have a think about what your plan is and how you're going to present your business, just as an overall.
Thank you. So the messages there are: it's never too early. Don't be scared to share your thoughts and opinions and walk them through with people who are experienced in it. Okay, well, listen, I can't see any more open questions. So I suppose it's time for me just to say thanks for giving up your time. We know you're all busy. We do appreciate you taking your time out and listening to us. I hope that the three of them, with the advisor, the investor, and the experienced CEO, has given you a clearer picture, lifted some of the fog, but given you some useful takeaways, especially if you are thinking about it. If you know anybody else that's thinking about it, please don't hesitate to give us a call. And thank you all very much. Thanks, John. Thanks, Scott. Thanks, Dan. And thanks everyone for your questions. And hopefully we'll hear from you all in the near future.
Thank you.
That's it. Thank you very much.
Great. Thanks everyone for joining.
Thanks, everyone.